Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P that is seeing a very intense sell-off here after having broken major bullish structures on its daily chart. The amount of panic in this market is absolutely astounding. If you take a look at put options being bought by retail options traders, you can see we're at record highs. $18 billion here in put options premium, completely dwarfing anything that we've seen throughout history. Of course, this needs to be put into perspective with the market cap of the S&P 500. But still, very impressive chart showing you panic we have right now. Bond yields are going parabolic, right? It's a breakdown of the bond market right here. The dollar is also going parabolic. Right here, you can see this price channel that we've had since 2008 right here has been respected even with the strongest dollar rallies currently attempting to be broken right now. This is obviously very, very bad for risk assets. And we're currently seeing volatility flirt with this resistance line right here. Is this a breakout? Is this a false breakout? Is it bullish? Is it bearish? That's something we're going to discuss in this video. Getting back to the dollar, getting back to yields, this is a major tightening of financial conditions that we're seeing. Bond yields, whether that's short-term rates, long duration bond yields are going parabolic. The dollar is going parabolic. This is a major tightening of financial conditions. This could have devastating impacts on the economy, not just in the US, but all around the world. So a lot of people argue right now, if we jump to the S&P, that we're witnessing the early innings of a major move down in the market, probably a much larger market crash as we see these financial conditions materialize into economic weakness and really a breakdown of the financial system. Personally, I think these are absolutely legitimate concerns. The Federal Reserve's monetary policy today is probably going to end up being seen as a policy mistake in the future. But of course, the markets are not that simple. Everybody sees that, everybody understands that. Is this the moment to bet that this is not going to be a complete market collapse, but just a standard correction? Let's find that out. First of all, let's take a look at the percentage of stocks above their 50-day moving average. You can see right here, 3% of stocks are trending above their 50-day moving average. That has not happened since June 2022, which of course marked the very bottom of the correction we saw in June, and then March 2020, and then 2011, the very bottom, and then October of 2010, not the very bottom, right? We've discussed this before, that the market continued moving down, but it did correspond to the beginning of the bottoming process of the 2008 financial crisis. So just looking at market internals, if you remove the entire fundamental picture, because I think a lot of people get confused by that. Of course, things look very bad when you get this type of reading. That's kind of the point. That's why the market is crashing. But it also means a lot of the bad news has been priced in, right? So the financial system was collapsing here around mid-October of 2008. Things were very bad, and yet this was actually probably one of the best buying opportunities looking back, right? Obviously, you could have timed the low a little bit better, but nobody is able to time the low. So if you're an investor with a long-term outlook, these have actually proved to be ideal rebalancing opportunities with an extremely favorable risk-reward ratio. Of course, that all depends on your trading style. If you're not willing to endure this type of pain as an investor, if you're not willing to endure that type of additional drawdown after the moment you've decided to step in and take advantage of a severely oversold market, of course, you shouldn't do that. We discussed this a few times before. When the market is capitulating like it is today, it's very unpredictable, it's very volatile, risk is extremely elevated, and so you could very well be early and the market can cover a lot of ground very quickly, and you have to know that that's a possibility and that it's not a perfect bottom timing indicator. No indicator is. If such thing existed, well, we'd all be billionaires, but this gets pretty close. A lot of these readings have coincided with major market bottoms, so this is about as good as it's going to get in terms of timing the bottom, but still carries a massive amount of risk, especially in the very near term. And this is what investing is all about. It's about weighing your risk. How much risk are you willing to take? On what time frame are you willing to take that risk versus your reward, right? How much reward do you want to have? By the way, if you're so far enjoying this episode, don't forget to smash that like button as hard as you can. It just takes a couple of seconds and it helps our channel out massively. There's a whole process of research and production that goes into making these videos. So if you want to help Game of Trades out, don't forget to do that. It is really appreciated. If you're not necessarily looking for exceptional returns, then you don't need to take advantage of these opportunities. You can wait for confirmation and buy in when the market has recovered and has shown a sign that it wants to recover, right? So that is up to you as an individual investor to figure out what type of risk, what type of return you want to have, and the type of accuracy you want to have. And we discussed that in the last video. These are very important concepts that nobody is going to be able to decide for you. And our approach at gameoftrades.net is that we have a 6 to 12 month time horizon where we really just focus on making the best bets based on the odds, based on our research relative to history. All of this, all of the research we do, we post on gameoftrades.net is quantitative work. It's about as objective as a research process can be. It's completely based on history, completely based on fact. Everything we put out is back tested throughout history to make sure that we don't have a bias in our work. And all of this quantitative work that's based on the odds and where we assess the data based on history is funneled into our model portfolio, our trading watch lists, and our rating. So you can clearly understand what the full view of the market is. There's a link down below that says gameoftrades.net on it. If you click on it, you can go to the free trial and test out our service for free. We really want as many people to test out the service, give us feedback, comments on the work that we're doing so that we can really build the best service for individual investors. That's the goal. We want individual investors to have access to the best investment research service with the highest quality bets, the most clear and transparent communication possible at a very affordable price. So in this S&P 500 update that we posted on Friday last week, we took a look at the VIX that was actually making a false breakout. So you can see we had this beautiful consolidation pattern throughout 2022. Each bottom here in the VIX marks bottoms in volatility. So they tend to coincide with big tops on the S&P 500. And you can see every top in volatility has coincided with bottoms on the S&P 500. And so we were always watching this consolidation range for potentially a breakout. And I think a lot of people have been watching this consolidation range for a breakout because that potentially means you're going to see that big capitulation event that a lot of investors are waiting for. Historically, that has happened and that has coincided with some of the major market bottoms throughout history, right? Spike to 46, spike to 46, again in 2010, 2011, 2015. So a lot of people are waiting for that breakout and capitulation event. It could very well happen, right? And as we just discussed a few minutes ago, capitulation events are incredibly unpredictable. They do tend to see volatility spike. You have a lot of uncertainty. And that's why bottoms in the market are so difficult to time. It's a common saying to say that nobody can time the bottom of a market, and that's completely true because volatility goes through the roof. So could it happen? Yes. Does it have to happen? Absolutely not. Right? And I think that's a big misconception. There's a lot of investors out there that are waiting for that capitulation before even considering to get back into the market. The reality is that there have been a lot of bottoms in the market without seeing a 46 on VIX. Now, what I wanted to focus on here is this false breakout that we talked about last Friday. And you can see here just a couple of trading sessions later. Obviously, if we take a look at the S&P right now, it's up big. But when we posted that article, the market closed below 3,600 points. And now, depending on where we close today, it could confirm that this was indeed a false breakout, similar to the false breakdown we had here. You can see in August, if I superimpose the S&P, this was a false breakout in volatility. Investors got too excited over a Fed pivot, over declining inflation numbers. Jackson Hole snapped stocks back to reality. CPI snapped stocks back to reality. And now we have this perhaps return of optimism that's coming into the market, depending on where the VIX closes. Now, of course, if you start to see the VIX come back up here and the breakout hold, that's bad news, right? So we're watching this very carefully. We're going to be making updates on gameoftrades.net as we see these developments happen. We're obviously not just watching at the VIX, but a huge number of indicators. And our conclusion, at least last Friday, and we're going to continue updating you guys this week, but the conclusion was that the retest of the June low we're seeing today, or at least what we had on Friday, may actually be successful, right? And may actually prove to be a bottom. Now, we don't have a crystal ball. We don't claim to know what's going to happen. And, big market declines, as we've seen over the past couple of weeks, can be incredibly risky, right? So it's an aggressive entry. It's definitely an aggressive entry point, but all we can do is bet on attractive buy the dip opportunities with an attractive risk reward. And so that's what we try and do with the greatest degree of accuracy as possible. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button and hit that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.